You know, in the world of high finance, some of the biggest risks aren't buried in complex algorithms, they're hiding in plain sight. Today we're going to pull back the curtain on the massive, shadowy market of private credit. And we're starting with a single headline that exposed a $500 million crack in the whole system.
So this headline drops in early 2025, and it sent a shockwave through the industry. BlackRock, one of the biggest names in finance, period, saw an investment of over $500 million just evaporate. A complete and total wipeout. And the question on everyone's mind was, how on earth does that happen?
Let's just let that number sink in for a second. $560 million. And to be crystal clear, this wasn't some paper loss or a temporary dip in the market. This was the entire investment. Poof, gone in less than 2 years. To figure out how, we have to look at the company that was right in the middle of this storm.
Okay, so the company was Alacrity Solutions, which is an insurance claims manager. Back in 2023, a BlackRock private equity fund swooped in and bought a majority stake. But fast forward to early 2025, the business is really struggling. The lenders who'd financed the whole deal, they stepped in, took control of the company, and BlackRock's huge equity position was just wiped off the map, zeroed out.
And we're not talking about small-time players here. Look at this list. These are some of the absolute giants of the financial world. Alacrity was sitting under a $1.5 billion mountain of debt. And check this out. Its initial leverage was over 8 times its earnings. That means its debt was more than 8 times its annual profits. That is a massive, massive bet that everything is going to go right. And when it didn't, well, the whole house of cards came tumbling down.
And that really gets to the heart of the matter. This wasn't just about one company that failed to make its numbers. See, Alacrity was funded by something called private credit, and its spectacular collapse is exposing some really deep cracks in a market that has become unbelievably huge.
So let's talk about this world of private credit. You hear it called shadow banking a lot because it operates largely outside the view of public markets and, a lot of the traditional banking rules. And it has completely changed the game for how companies get money. So what is it exactly? Well, put simply, it's when big investment funds lend money directly to companies, cutting out the banks. After the 2008 financial crisis, a bunch of new rules made it tougher for traditional banks to make these kinds of riskier loans. That created this huge financing gap. And believe me, private credit funds were more than happy to jump in and fill it.
And the growth has been, there's no other word for it, explosive. In just a decade, this market quadrupled in size to over $2 trillion, and it's on track to hit $3 trillion in just a few years. But all this rapid expansion, all of it fueled by a relentless hunt for higher returns, has planted some serious risks that go way beyond Wall Street.
For years, super low interest rates kind of papered over all these risks. But now that borrowing money is expensive again, those cracks are really starting to show. So we're going to break down 3 of the biggest ones: fuzzy math on valuations, super aggressive loan structures, and something called pencil yield. First up, opacity. One of the biggest problems in this whole market is just figuring out what these loans are actually worth from one day to the next. See, unlike a public stock or a bond, there's no daily price ticker you can just look up.
And this really shows you the core difference. Public stuff is marked to market. Its value is updated constantly based on real prices. Easy. But private loans are marked to model. This means their value is decided by the fund manager's own internal math. It's totally subjective. And, it can easily hide problems, leading to a situation where the official value doesn't reflect the reality on the ground at all.
Okay, the second major risk is baked right into the loan agreements themselves. With so much cash flooding into private credit, the competition between these funds got absolutely fierce. And to win deals, they started offering much, much looser terms to the companies borrowing the money. A lot of these loans became what's known as covenant-lite, which basically strips away all the early warning systems that used to protect lenders. It's like taking the check engine light out of your car. And at the same time, companies were allowed to just pile on more and more debt. So you put those 2 things together, and it means that by the time a problem is obvious, it's often way too late to do anything about it. And that brings us to risk number 3, and this one might be the sneakiest of all. As this quote explains so well, a good chunk of the income that investors think they're getting is something called pencil yield. It's profit that exists only on paper. No actual cash has changed hands. This magic trick happens through something called payment-in-kind interest, or PIK. So when a company is struggling and can't make its cash interest payment, the lender just says, hey, no problem, just add that amount to your total loan balance. It's exactly like paying your credit card bill by just asking the bank to increase your credit limit. On paper, the lender gets to book income,
But in reality, the borrower is just digging a deeper and deeper hole of debt. It's a way to mask distress.
So you have all this going on, the fuzzy valuations, the risky loan terms, the paper profits, and for a long time it kind of worked because money was cheap. But the era of 0% interest rates is over, and now this entire $2 trillion market is facing its first real stress test.
And if you want to see how this all plays out in the real world, you don't have to look any further than the car wash industry. I'm serious. In the early 2020s, private investment firms just fell in love with car washes. They saw this simple, cash-flowing business, and they piled in, creating this absolute gold rush to buy them up. And just look what that did to valuations. The price they were paying for these businesses, measured as a multiple of their profits, just went through the roof. By 2024, they were paying over 16 times earnings for a car wash. The ratings agency Fitch even called these valuations stretched. I mean, it was a bubble, plain and simple. And the fallout is already here. Zip's car wash filed for bankruptcy, and its lenders had to take a 25% loss on their loans. And it's not just car washes. A home remodeling company called Renovo, which had used that PIK interest trick we just talked about, went into liquidation. Total loss for the lenders. So yeah, the big test is here, and some of these companies are failing, big time.
So this all leads to the final and most important question. Why should any of this matter to you if you're not a big shot investor? Well, the answer is that this shadow market isn't really in the shadows at all. It's deeply, deeply connected to the traditional banking system that we all rely on every single day. Here's the critical link that nobody talks about enough. These private credit funds don't just use their investors' money. To juice their own returns, they borrow massive amounts of money themselves. And guess who they borrow from? Yep, big traditional banks. According to the Federal Reserve itself, by the end of 2024, regular old banks had provided almost $100 billion in credit lines to these private funds. So what that means is the regulated, safe part of the banking system is acting as a financial backstop for the much less regulated, riskier part. And that brings up a really chilling question. What happens if there's a real crisis in the private credit market? If lots of these funds start seeing defaults and their own investors want their money back, what are they all going to do at the exact same time? They're going to run to the banks to draw down on those credit lines. And that sudden, massive demand for cash could put an incredible strain on the very banking system our economy is built on. And that really leaves us with this final, sobering thought. The risk didn't just vanish after the 2008 crisis. It just moved. It migrated from the well-lit, heavily regulated world of public banking and into the shadows. And the question we all have to ask now is, what happens when somebody finally turns on the lights?